Hi there, Matt. Well, let's get you some more insights on where oil prices could go next as we continue to monitor these significantly higher levels, indeed the highest that we've seen in 2019. Very pleased to say that joining us now is Paul Horsnell. He's Head of Commodities Research at StanChart's. Paul, thanks so much for joining the conversation here on CNBC as we look at these prices, very significant moves. Do you think oil is looking perhaps a little bit underbought, though, as Ed Morse told me yesterday?
I still think there's a little bit further to go in prices. We're moving back into sustainable range. We're really unwinding that undershoot of prices that happened at the end of last year when prices just went down too low.
How much more upside do you think there is then?
I think certainly there's a sustainable move well into the 70s. At StanChart's, we're looking for Brent to average $74 a barrel this year, which would imply prices for the rest of the year averaging somewhere north of $76 a barrel.
One of the key uncertainties in the market at the moment is what the US president is going to do on these Iran sanctions and waivers. What do you think is going to happen in that regard?
Up to now, the approach, I think, has been very pragmatic. It has depended on prices. Trump makes it very clear when he feels prices are too high. He's been tweeting that for the past few months. So I suspect the decision will come down to a pragmatic view on what is going to be the impact on prices as we come up to the May deadline for the renewal of the waivers.
So you think he's going to extend those waivers?
No, I think it will depend on market circumstances up to there and that trade-off between, if you like, the politics and the economics in terms of the oil price implications.
What do you think he cares about more, crimping down on Iran or ensuring some downside pressure on domestic oil prices and hence fuel prices in the US?
It's not clear, but I think again we have to step back. I mean, Trump is not the most important factor driving prices. I think we've seen his social media comments really don't have that much impact, sustained impact on prices. So prices have been driven by supply and demand here, not by what Trump is doing or might do. And it's on a supply and demand basis that we do see the need for prices just to rise up into that sort of mid-70s range.
I mentioned earlier that we had a conversation with Ed Morse over at Citi. He says when it comes to this June meeting for OPEC, there's a likelihood that they may not extend the OPEC Plus supply cut production agreement. What's the Standard Chartered view on that? Because the commentary that we've heard from the Saudi Energy Minister, Khalid Al-Falih, and others has been that, yes, they are leaning towards an extension. So what do you think could happen?
Well, I think they will be driven by their view of the supply and demand numbers as they get to mid-year. On our supply-demand balances, we don't see much scope for a large increase in OPEC production to the back end of the year, which would imply some sort of rolling over. But of course, there are a lot of situations between now and then that could come through. Libya is another source of uncertainty in terms of how sustainable its supplies can be. There are various other geopolitical situations. Venezuela's another one. So I don't think anyone in OPEC will commit to the June meeting yet. They will take a good look at those supply and demand numbers, see what happens in May with the waivers, and then take their decision based on that.
You mentioned Libya. Is this a situation that the market needs to be paying more attention to? Clearly we've seen an escalation of tensions there, but this isn't something new, really.
It's not new, but the recent escalation clearly is a significant escalation. I think the market really hasn't concentrated on Libya as much as it perhaps should have done, but it's a very slow-moving, long story, so I can see why the market's attention drifts off. But at the moment, we do see threat to Libyan supplies in the short and medium term.
Do you know how many barrels specifically could be coming offline as a result of that situation?
Well, again, obviously it depends how things play out in terms of the fighting around Tripoli, whether the reconciliation conference can make any progress. But if we are breaking down into this kind of east versus west Libya distinction, then the immediate barrels under threat would be those from the southwest, which come up through into the west of the country. So that would be El Shahara and a good sort of 300, maybe up to 400,000 at immediate risk. But again, it's the uncertainty of those supplies rather than the immediate changes in the flow.
As you mentioned, one of the other situations that the oil market has been very closely looking at is Venezuela. We've already seen significant barrels coming offline as a result of those US sanctions against the state oil firm there. But do you think the US is going to push ahead with another wave of sanctions given the political crisis that still engulfs this country today?
Well, I think US policy is increasingly very difficult to judge. There used to be a time when there were some basic ground rules and you could more or less work out what the policy would emerge. And I don't think those ground rules work anymore. So so it's very hard to tell. But I think in terms of the policy as set, it's clearly one which does seem set on regime change in Venezuela. That's never going to be constructive for the oil industry, and you would expect to see an acceleration of the declines in Venezuelan production over time. But how much of that is policy and how much of that is happen chance, I think we'll find out in retrospect.
Absolutely. All right, Paul, we're out of time. We'll have to leave it there, but thank you so much for joining us today.
Pleasure.
Really appreciate it. Enjoy the rest of the conference.
Thank you very much.
That's Paul Horsnell there, the Head of Commodities Research at Standard Chartered. Matt, it's back over to you.